ICT is keeping you unprofitable. Why? Because you have enough already to become a profitable trader. And I spent years studying ICT, and to be honest, I could have been profitable within 3 months. And the reason I wasn't is because I approached it with the mindset that trading was a degree. That is complete BS. Trading is a business, and we are here just to make money. So in this video, I'm going to show you no BS, what you actually need from ICT's concepts to start making money today. Okay, so after 5 years of trading, there's literally only 3 things you need to be a consistently profitable trader, and that is liquidity, which is number 1, number 2, liquidity sweeps, and number 3, a simple entry pattern. That is all you need to become a profitable trader on the technical side. Of course, you need trading psychology, which this isn't the video for, but in terms of technical analysis, the first thing you need when you get on the charts is you need to look for liquidity, right? And you know, if you've studied ICT's concept, you'll know liquidity is one of the most important things that he always talks about. Now, for your bias, daily bias, weekly bias, higher time frame analysis, whatever you want to call it, the only thing you really need to understand is what high or low is price going to go for on the higher time frames, right? And by higher time frames, I mean the 4-hour, daily, and weekly. Now, again, after probably about 5 years now of studying trading, I think you should just use the 4-hour chart because it's very easy to spot what liquidity price is likely to go for intraday, right? Because if you use the weekly chart and there's like some significant high, all the way over here, it's kind of hard to understand. Okay, what's price actually going to do in London session, right? Are we actually going to go all the way for this weekly high over here, or are we going to drop to a fair value gap? But on the 4-hour chart, it's really easy to see what price is going to do within the next few hours, right? So right here at this high on the 4-hour chart, lots of liquidity, right? Lots of liquidity, lots of stop loss orders, and we know that price, what does price always do? It always comes and it breaks through liquidity. Now there's an order block here, so very likely that price could either do 2 things. Either 1, smash through this liquidity pool, hit the order block and reverse, or just continue upwards. And of course, as recording this, right, so who knows what could happen. As recording this, we're in a massive bull market in gold. Never ever try to pick the bottom, the tops. And in a bull market, similarly when we're bearish, never try and pick the bottom. So what we at least know in price action is that price is going to come towards this high here. Right? Now, what does that actually mean? Because people get this confused all the time. That right there gives us our daily bias. Right? That gives us our bias for every single session, every single time frame, whatever we want to trade. The highest probability setups will be in this direction, right? So on the lower time frames, what we want to see is price. Let's imagine this is the 1-minute chart or 5-minute chart. We want to see price, come towards this liquidity pool, and then we want to enter on a fair value gap or order block or even optimal trade entry and ride price up. And we want to keep doing this until price hits this target. The moment it hits this key liquidity pool, we're going to wait and we're going to see, does price respect this order block or does it keep shooting up? And if it does, then we'll target this high here, right? So that right there is your daily bias. So when we get on the lower time frames, when we get in whatever session, we're only going to look for longs. Okay, so here we are on the 1-minute chart, and again, you can use this concept on any time frame because price is fractal, right? Which literally just means these concepts work on any time frame. But I'm on the 1-minute chart on gold, and I'm going to show you an example in New York session. Now, New York session is 7 a.m. Eastern time, right? All the way up until 10 a.m. Eastern, all the way over here. But we're just going to study this bit of price action right here. And can you notice, like literally almost as soon as we hit 7 a.m, what price does, and I'll give you a high level overview before we go in a bit more detail. Can you see how price instantly starts to drop? It takes out stop loss orders here, 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 and then we get into a fair value gap. But these 3 stop loss orders, or these 3 liquidity pools here, here, and here, is what we're interested in. Price drops instantly, takes out liquidity at these 3 lows, instantly shoots off, gives us an entry here, and then we ride price up. That right there is one of the highest probability setups in price action, and I've taught thousands of students this, and they've become profitable with just this framework alone, right? And you'll see this in every single time frame, all the way in the 4-hour, daily, weekly, all the way down to the 1-minute chart, even the seconds chart. This exact thing where we have the higher time frame bias, which is the most important part, right? Because we don't know what price is going to do unless we know what the higher time frame is telling us, and we determined on the higher time frames that we're bullish. So if you remember when I said right at the beginning of the video, there's 3 things we need: liquidity sweeps, and then our entry pattern, right? So we've got liquidity, right? That gives us our bias. We know we're only looking for longs. What we want to see is a liquidity sweep, which is just a stop run, right? It's a fake move in the opposite direction of the daily bias designed to take out stop loss orders before price quickly shoots off in the overall direction. It gives smart money traders a a retracement to enter on, and the price goes straight for the higher time frame liquidity, right? It's a fake move. It's a fake move before price quickly shoots off, and it's only designed to take out stop loss orders. So if we know here, let me just mark this out for you. This low, this low, this low, these triple lows here, there is lots of liquidity, right? Now this liquidity here is nowhere near as important as the liquidity, all the way up on the 4-hour chart, right? But I'm just showing you intraday liquidity, almost London's low, although London's low is like somewhere around here. But we've got lots of liquidity, we've got triple lows. What does price do? It instantly drops, almost algorithmically at 7 a.m. It drops, takes out liquidity at these triple lows, shoots off, gives us our entry, which we'll talk about later, and then massively, look at this, right? Massively, all the way up here, right? All the way up here, right? Okay, so we've got our liquidity sweep, which is this fake move here, which takes out these stop loss orders. The third and final thing, which is the least important part, is our entry, right? All we need now is a simple entry pattern, right? And for this model, I'm going to give you the fair value gap. Now you can use the order block, optimal trade entry, it doesn't really matter, right? But all we need is a simple entry. And can you see, and this is something I say to my students, right, which makes it really easy to understand if it's a liquidity sweep, right? If you want like a high probability, or hey Atif, how can I be really sure it's a liquidity sweep? What you want to do is you want to wait for price to take out stop loss orders, right? Take out stop loss orders, shoot off in the opposite direction, and leave a fair value gap. And now this fair value gap should be in the opposite direction of the liquidity sweep. Or an easier way of saying it is the fair value gap should be in the daily bias direction, right? And if you remember, we're bullish on the higher time frames. We're going to take out that high on the 4-hour chart. So we're looking for a fair value gap to form in that direction, right? The fair value gap is essentially smart money or algorithmic price action showing you that price wants to move in that direction, right? Look at this. Just look at this. Let's just remove this arrow here. Look at all this chop we have, right? All this chop around here, lack of fair value gaps, and a huge bullish fair value gap. Here's our entry, and then look at this. Price is literally gapping up just to go in this direction. Now the reason we get such an aggressive move is because this is in the overall daily bias direction, right? This is why it's not enough just to short, at a random fair value gap here, hoping that price goes down, right? It's not enough to do that. We have to wait for our liquidity sweep, and we have to have the overall narrative. But anyway, for your entry, what you're going to do, enter on the fair value gap. You're going to put your stop loss not at this fair value gap here, not in the midpoint of this order block. You're going to put it at the liquidity sweep low. The whole reason we waited for a liquidity sweep is so we could put our stop loss in a safe area, because what used to happen to me, what happens to so many traders, is they can get the bias right. So they know, they can get the bias right, but what happens is price comes up and it hits their stop loss right here and then goes straight to their take profit, right? Now because we waited for a liquidity sweep, right? Very unlikely that price, right? Because remember, price only came down to take out stop loss orders here. Very unlikely that price is going to come up, leave a bullish fair value gap, break the bullish fair value gap, and take out this liquidity sweep low, and then go in the overall direction, especially when we're bullish on the overall higher time frame. Very unlikely that's going to happen, but there is a possibility, right? There is a possibility. And what also is a possibility is that price could just retrace and hit this order block, right? So if you have your stop loss super tight, price could just wick you out and go straight to your take profit, right? So very important that we put our stop loss at the liquidity sweep low. And then for your take profit, if you wanted to target liquidity, you could target this high here, but I would always say target at least a 2-to-1 minimum. For me, I always target 3-to-1. So here's your 2-to-1, nice and easy 2-to-1. If you target 2-to-1, you can get such a high win rate with this model on any asset or any pair, and you'll get yourself every single day if you use the 1-minute chart, in at least one of the sessions, right? So, and then the 3-to-1, nice and easy. Now I always say to my students, and I say this in general, don't aim for a 4-to-1, because what usually happens is price will, like it's done here, right? It will just wick out. It will just hit a 3 risk to reward ratio, or consolidate, or reverse. And I think maybe in this case you do get the 4-to-1. Right? Let's see. Do you get the 4-to-1? Yeah, just about, right? So, but for me, I'm one and done. I have a fixed risk to reward ratio. I don't do partial. I don't do break even. I don't add to positions. I just do it nice and simple, right? I get into my entry and I let price do its thing. That is all you need to be a profitable trader, right? Don't let these guys with insane win rates, most of who are lying, convince you or delude you. All you need is a 50% win rate and a 2 risk to reward ratio to be a millionaire, right? That's all you need. So that right there is all you need from ICT's concept to become a profitable trader, right? Now, That entirely isn't true, because if you can have this model, you can master this model, but if you haven't mastered your mindset, you're never going to make money in trading. So make sure you go watch this 7-minute video where I condense everything you need to know about trading psychology into one video. So I'll see you on that video on screen now.